Good afternoon. This is Dan Goerlich. I'm a deals partner with PwC based out of our Atlanta office, and was asked today by my partner Amber Cutler to lead a panel discussion around SPACs. Special thanks to Amber, Rebecca, and Jeff for pulling together a really great intersection panel to have a spirited discussion about this emerging trend, which has really boomed and had a big impact on fintechs over the last year. We have a banker as well as an academic to sit here today with us and walk through the SPAC environment and how it can be impactful for fintech companies. So just by way of quick introductions, with me here today to do this discussion is Sudheer Chava, who's a professor at Georgia Tech. He actually leads the finance department at Georgia Tech here in Atlanta, as well as the director over the Masters in Quantitative and Computational Finance. So we'll bring a depth and background to the discussion from academia. And then also with us here today is Peter Early from Exos. Peter is a banker by background, had his start with Bankers Trust, and then moved into the hedge fund realm shortly thereafter, but has been in finance and banking his whole career, leading hedge funds from both an investing and capital management perspective. Peter has recently, going back to 2016, joined Exos and works with this as a fintech organization. Exos, obviously started by the former CEO of Credit Suisse, Brady Dugan, is a very modern and disruptive iBank. And in Peter's role there, he's obviously been in the midst of all things SPAC, and will be able to kind of walk us through and give some perspectives on this today. So Peter and Sudheer, welcome. One of the things that I wanted to at least set some background on as a logistics item. So there's a Q&A button at the bottom of the screen here in the Zoom call. If anyone has any questions that they would like addressed as we move through the content, please put them in at any point and we can administer that on our end. So just use the Q&A function at the bottom. What we're going to do is go through a good 45 minutes of content. We've prepared this in sort of sections based on introduction to SPACs. So if anybody's sitting on this WebEx wondering, what is a SPAC or doesn't have as much familiarity, we'll start there. We'll talk about the SPAC experience for a fintech or for companies that are being sought out as an opportunity to go public through a blank check company, and then really move into macroeconomically, what does this mean going forward? What are some of the pros and cons of partnering through a SPAC to go into the capital markets, and where do we think that this is all headed? And so without further ado, I'll jump into this, and I think the best place to start would just be an introduction to where we've been in the history with SPACs. So Sudheer, let's start with you. We obviously have been hearing nothing but news about SPACs. Anybody who's reading the Journal and other trade articles, and the number of capital transactions that are happening with new SPACs launching, this seems to be just a big booming trend. We're seeing it on CNBC, all over the internet. Can you maybe just help us understand historically, is this new or is this something that's been in existence for a while now?
Thanks, Dan. I'm very happy to be part of this panel and also participate in the Tag FinTech events. I always enjoyed these panels and events. Just to take a step back, I think SPACs, again, there's so much news about SPACs, are the blank check companies, as you said. I think probably the amount of media coverage, I think, on these over the last few months has been really crazy. But if one takes back, I think SPACs are just one type of blank check companies. Again, as an academic, I always look at the history, even though one can argue that the SPACs right now are very different from the SPACs before. SPACs are one type of blank check companies. And again, as you know, the blank check companies are just the development stage companies, which don't have a specific business plan, but their idea is they want to go and attract or acquire other companies in the future. So SPACs are, first there's an IPO of the SPAC, where a sponsor comes in, they might do an IPO of the SPAC because they want to raise the funds. So in that case, similar to a traditional company, operating company going public, here we have a non-operating company. In this case, the SPAC is also a cash shell company going public, first raising the funds. And then these funds are put into a trust or escrow account so that there's some downside protection for the investors. And then there's typically 18 to 24 month time period during which the sponsors can go and try to find targets, which I think might be attractive enough for them to acquire. So the IPO happens first, and the proceeds are placed in a trust, and afterwards, this typically a 18 to 24 month time period, when they can go and attract the like an attractive target. If one goes back, what happened was the SPACs, even though the broad concept remained the same, the type of companies that are going public through SPACs have changed, the type of targets have changed, the amount of funds have changed, and where they get listed changes. That is, if one goes back early, like SPACs from 93 onwards, there's around 158 of them, I think, before the great financial crisis, 2010. Most of them actually listed on the OTC markets. So that's why some of the initial bad rep for blank check companies came in, because they're penny stocks, but I think that's SPAC 1.0 in a way, right? And then I think we have the new SPACs, I think after 2010, we can call it SPAC 2.0, and then again, SPAC 3.0, 4.0, if once with the Virgin Galactic, maybe it's the new SPAC, SPAC 4.0. So what changed was, in terms of the structure has become better with more protections for investors. Over time, the number of warrants which are included as part of the deal had changed. The type of companies, there's more high growth companies in electrical vehicles, in biotech and fintech. These companies have changed, and also at what stage they are actually acquiring the companies and how much they're paying for these companies, they have changed. And one more thing that had changed over time was, initially, the SPACs, the promoters take around 20%, which they don't put money as sponsors. But still, there used to be in the trust around 85% of the money is we put in the trust. Because when they raise the money at the IPO, the promoters get an automatic 20% stake. They're not putting cash for that, so they can put 80-85% in the trust. But over time, the sponsors are putting in 100%. In a way, they're taking some of the risk. So that way, the downside risk for the investors had changed, who invests in the SPACs. And in case of this 18 to 24 month time period, an acquisition hasn't happened, there can be a liquidation event where the investors get their money back, both the original money, but also any interest earned during this time. So I can talk a bit more about it later, but Peter, I think, has some very great insights on this one. So I'll come back later if need be.
Yeah, I mean, Peter, anything to add to that, just in terms of the mechanics of how the SPAC works from sort of start to end, when the initial formation through the pipe and some of the other things that come in?
Yeah, no, absolutely. So I really try to think to simplify it. SPACs are super cool, and really it depends on what angle you're going at. There's a few different parties in a SPAC, and so starting with the company, why would a company use a SPAC? It purely is an alternative route for them to go public. And so, they can compare it to a traditional IPO. I would say, as Sudheer said, there's been a big explosion in the market. It really started with this Virgin Galactic transaction. And I think at its core, there's a fundamental reason, and that's that going public via SPAC has some categorical regulatory advantages over a traditional IPO in terms of how a company can tell its story to a market. And in the old days, that didn't matter because you had a glue company or an iron ore company. But when you think of someone like Virgin Galactic, if they were to go through a traditional IPO, they fill in a government form called an S1. It's really a snapshot of where they stand today and what's happened in the past. And if you think of that company, that tells you nothing about what they're doing. Like 100% of the value of Virgin Galactic is in the future. Space travel, does not really exist yet. And so a SPAC really, doesn't have the same confining forms. You have the ability to have a dialogue with the public market investors, with the public market at large, tell about your mission, your goals, your vision. And so, forgetting about anything else around the price or not the price, it just really is a better format for what I would call innovation-based companies to go public. And it's just a regulatory advantage. Then, you go to the other side, like, why would someone buy a SPAC and an IPO, an investment tool? And these things are just unique. They're an interesting structure. As Sudheer said, what happens in the IPO is you buy a unit where you get common shares, and then you typically get some derivative like a warrant. And uniquely, all that money goes into a trust and sits in T-bills, and you have the ability to redeem your common shares for those T-bills. And so if you think about the implications of that, what it really means is, in a really bad scenario, either the sponsor doesn't bring a deal, or say the world ends and there's never another deal, your money's protected by US government securities. It's not corporate cash flows, it's not lending club loans, it's not equities. Like, it is literally the best collateral you can have. But when you're in a good state of the world and things are booming like they have been today, you own a series of equity options that can provide incremental return. And historically, those have been worth almost 10%. Lately, they've been worth even a lot more than that. And so, again, it's just a super cool hybrid structure that has some characteristics of equity, some characteristics of fixed income. In fact, you can use those in your portfolio in a lot of neat ways. And then the third part of, call it the triumvirate that's involved in these SPACs is the sponsor. And the sponsor is really the guy that facilitates all of this. And so, you could not buy in an IPO and have your money sitting T-bills in trust, except for the sponsor, because he puts up all the money to pay the fees, the lawyers, the investment bankers, all the things that take that vehicle public. And so I think there's been a lot of talk about sponsors and SPACs generally in the media, and I don't think it's well understood. There's this idea out there that these sponsors are ripping everybody off, and they make all this money for no reason. I look at it this way. I think of them. They are in this regulatory advantage structure, the investment banker. And so if you think of a traditional IPO, the company hires an investment banker, then investment banker puts up no money. He goes and raises money, takes them public. And in the end, the company writes him a big check in cash. And so whether the company goes up or down doesn't affect him. There's no alignment of interest. If you think of the sponsor like an investment banker, he puts up his own money, which pays all these fees, which facilitates this, really unique, interesting structure. He then is the guy that helps the company to think through how it's going to tell a story to public markets. He assembles the team. It can include other banks that will help raise money, provide research, do all these things that are going to help you in public markets. When you close that transaction, like an investment banker, he gets a big check, so he gets paid, but this check's not in cash. It's 100% in stock. And in fact, he can't sell that stock for a meaningful period of time, at least a year, which gives a big alignment of interest. His fee is at risk if that deal is not good. And if it goes up, then he's going to make more money. And so those are really the three corners of the SPAC market, the sponsor, the investors, and the companies. And I think there's been a lot of media attention. I actually think that there's a bunch of fundamental reasons, and so there's a lot of cool things going on.
Yeah, Peter, a follow-up question that we just got in, I think this will help maybe land the downside of some of these blanked up companies and what happened. So Sudheer was describing the blank check, and when you launch the initial IPO, then that SPAC organization has a mandate to do a transaction, right? They have a period, generally it's around 2 years, to go out and find an acquisition partner to do the actual monumental trade. What happens in the case of the situation wherein they can't find a relevant target? The liquidation, which is the term where they get the investors that put the initial capital in, liquidate that trust. How does that work pragmatically? And then also the follow-on question to that is, what happens to the sponsor's 20% share? Does that at-risk capital go away, or do they just get it returned in T-bills?
Yep, no, that's right. So good question. So first, from the sponsor's perspective, that money is absolutely at risk if they don't bring a deal. And it could be because they can't find one. It could be because 2008 happens and the world ends. They lose 100% of the money they put up. So that is absolutely at-risk capital. And if you think of that from an investment banking perspective, that investment banker, is really putting up his own capital to help you go public. From an investor's perspective, though, there's no risk, meaning if for whatever reason that sponsor, doesn't bring the deal, your shares are automatically redeemed for your share of the money that's held in trust. You get paid interest, so it's not a lot of interest these days, but in prior times, you actually got the interest that was accruing to you in trust. And so again, if you think about that from an investor's perspective, you're investing in this instrument that worst case, you're going to get all your money back plus T-bill interest. But if the sponsor brought a great deal, then you could have this equity option pay off and you could get an incremental return. You typically will get some kind of warrants or derivatives associated with it that can add to that return. And so I would say it's almost like a chameleon. On one side, it's really, fixed income protected by the best collateral out there. On the other side, you have these equity options that can be incredibly valuable. You've seen the best of deals go up 100%, which for fixed income risk on the downside, that's just a mind-boggling thing to think about.
I agree with you. Just to add, I think a couple of things. There's definitely skin in the game for the sponsor. So they have incentive to find good deals because all their payments would come in as equity to these companies, and they typically also have warrants, which also they put in money through that. So at the liquidation, in case they don't get it, they don't make a deal, then they lose that money. So they can extend the time period a bit, I think, but typically there might be some incentive towards the end to get into acquisitions, which might not be as good. But again, since they are going to get equity in the resulting company, that might not be as much. And I would differentiate between the investors. The downside risk for investors definitely is lower, but I would differentiate between the investors who invested through the IPO at the initial stage, who bought at $10. So for them, it's actually like you can make as much as 9%. Professor Jay Ritter at Florida has done a lot of work in this area. And I think one of his recent work, he shows that around 9% return, 9.3% is what these investors, if you buy in at the IPO and then sell 5 days before the merger closes, you can make around, on average, 9.3% risk-free, right? That's great. But the issue is, what about once it starts trading, the SPAC starts trading before the de-SPAC period, that is the merger happens, some of these are running up a lot, right? Some of them, I think, went to $20, $30, even more. I think one recent one even went to $50, I think, because of the speculation about what type of target might be acquired and how much it's worth. So for those, again, that $10 is what they would get, no end. So I would differentiate between the investors who invest initially, who actually get, for $10, they get both the stock and a downside protection at $10 plus interest. They get a warrant, and typically the warrant returns are reasonable. So for them, it's there. But those investors who purchase afterwards, especially if there's a significant run-up, for them, again, in liquidation event, they would be getting only $10, right? So I would really think we have to differentiate between the two.
And I actually think that's a good point. And something interesting to think about is, there's $10 in trust, or it could be 1010. The documents will outline how much money is in trust protecting your investment. And as Sudheer said, some of these things will go to 11 or 12. And so if you buy it there, you only have $10 protecting your investment. So it's quantifiable. There's great properties about that. The corollary is, many, many times throughout history, these things will actually trade at less than 10. And so, like, if you even go back to October of last year, you could have bought the average SPAC at, $9.80 and had $10 of T-bills in trust. And so, you invest in a T-bill and you earn 0.2%, or you could have bought, a bunch of T-bills via this structure and earn 2%. And so it is something, again, to me, SPACs, they're not good and bad. They're a vehicle, but they have these unique characteristics that I think lead to all kinds of interesting opportunities. I do think Sudheer is right. You can't just be naive about it, just buying these things at any price. At its core, the higher they go above 10, the more they are like equity. The more they go towards 10 and ultimately below 10, the more they're like fixed income protected by real government securities.
And do we have any data, just longevity-wise? And as Sudheer mentioned earlier, these go back to 1993. Like, what percentage actually liquidate as opposed to going through with the investment? It's obviously going to be exacerbated data given how successful these have been over the last couple of years. But what do investors look like in terms of liquidation or wrap-ups of these SPACs?
I can take that. So importantly, they made some fundamental changes to the structure in 2015, such that the data before that is just different. So it used to be, a much lower proportion of these things would find a deal, and so more of them liquidated. But in 2015, what they did is they separated out my ability to vote for a deal with my ability to get my cash back plus my interest. And so what that means is, if a sponsor brings a deal and he wants to do it, but I'd prefer to have my money plus interest, I can vote for the deal and let him do that deal, but I can take my share of the money back. And so you even go back to like the Virgin Galactic transaction. it was a meaningful proportion of the money that sat in trust was redeemed and went out of that deal, and it ultimately closed, performed well, and so they would have been better off staying. But so post those changes in 2015, it's 80+%. Prior to this latest boom, where it's been almost 100%, and so maybe the last part of that is if we talk about pipes, which we haven't introduced yet. Really, a SPAC's a flexible structure from a company's perspective. And as part of that, what it means is when you merge with a SPAC, the investors have the option to put their money in or take back their share of the collateral. And so that's uncertain. If you're a company that's going public and you say, I'm merging with a $100 million SPAC and I may get 100 or I may get 0, there's some negatives around that. But what's happened with the pipe market is in most of these deals now, they'll raise what's called a pipe, which is a public investment in private equity alongside the SPAC merger. And what that does is it gives guaranteed financing so that if you merge with a $100 million SPAC, you may get $100 million, but you will raise from Fidelity and BlackRock and a bunch of big investors, call it another $100 million. It's all invested at 10 typically. It's guaranteed to close. And so what that means is now as a company, you can say, well, I may get 100 million or I may get 200 million, but if I get 100, I'm okay. And I'm going to close this anyhow. And so what it's really done is this provided a lot more certainty around closing. And so you've seen a higher and higher proportion of these deals actually close.
Yeah, I think as Peter rightly said, I think the liquidations over time have been coming down because SPACs, I think, have adapted to the market and the structures have become better. Investors became more comfortable with it. And the pipe helps because the average SPAC nowadays rises around $300 million, say, or even less, right? But some of these deals, many of them are multi-billion-dollar deals. So the private investment, public investment in private equity, this one I think is definitely a big deal. And this is where also I would say the sponsor matters, because you're not only like selling to the initial investors, but now you have to have the network and you have to have the connections to bring in these other investors to put in these big dollar amounts to fund this kind of multi-billion-dollar acquisitions. That's where the sponsor matters. So right now the liquidation events are low, and even the liquidation events, the investors don't lose out. But going forward, again, one has to wait and see. This is where right now there's around 400 SPACs which are actually looking for targets. And there's probably another 200 launching. And I think from what I hear, the latest on Wall Street is anyone, if you are worth something or you have a name, you have to have a SPAC to your name, right? But I don't know if there's enough targets there, enough good deals out there, which might be like worthwhile for the investors. The investors agree that's a good deal for them. So maybe a year down the line, what we'll see is we are seeing the initial SPACs and acquiring companies that are happening now because they raised money a year and a half back. Because typically that's what the overall time period takes. But the companies which have raised SPACs and which are rising SPACs now, we are going to see over the next year and a half or 2 years. So that might change if this market conditions change, or if they might not be able to find enough targets.
I want to come back to that point in a little bit, Sudheer, in terms of how the number of new SPAC entrants is going to affect the number of targets that can access these, or what the bidding is, or some of the economics. But one thing you pointed out, which I think would be important for us to go through a little bit, is who are the players that are sponsoring these SPAC transactions? I mean, obviously, a lot of the hedge funds and private equities have launched SPACs, and some names that we know well. But candidly, you're starting to see even celebrities get into SPAC space, right? Like A-Rod is a SPAC, a SPAC sponsor, or at least a part of a consortium that did a SPAC sponsorship. And just for everybody on the call, it's very topical. The SEC actually just, introduced a warning or investor bulletin this morning, basically providing investors with a caution. And it seems pretty common sense, right? But it's something that they felt behooving to do, a caution to basically say just because a celebrity is attached to a SPAC doesn't necessarily make it a viable investment. It's on you to do your research related to that. But can you talk a little bit about who the players are and the evolution they're in? It'd be good to get Peter's comments after yours, but I think that'd be helpful for the audience to hear.
Sure, I think you bring a very important point, and I think as an academic, I think these are the things that we worry about. If we look at, I think, the SPACs, a couple of things, right? I think Peter mentioned earlier, that one of the big regulatory advantages of SPACs versus IPOs, even though like many proponents talk about costs and they talk about the time period it takes, I don't think they're as different. I think the bigger difference is this regulatory advantage where you can go and tell your story, right? The thematic stories, electrical vehicles. If you look at the ones which are really hot, electric vehicles, biotech stocks, high growth, and they might not have as much of profits or sales, but now you can go out and tell the story. That naturally brings in people, again, with a megaphone, right? Celebrities or others, I think, who might be able to reach to a larger audience. I think that SEC is right to be very concerned about it. This reminds me of a few years back when there's initial coin offerings, and from Mike Tyson to everyone was tweeting about that, and then that was outlawed. This one is not at that stage, and that is much, much better than those ICOs. But still, I think there is some concern. I think so. SEC, I think, is right to actually talk about it. So, where if we go back and look at the SPACs and the promoters, the sponsors, basically, many of the initial ones are those with a deep expertise in the industry. So, for example, many of you know Betsy Cohen, the bank corp, right? She has the Fintech acquisition corp. So, deep experience in banking industry goes and sets up a SPAC. Or somebody like with the CFO of JP Morgan. Or I think you have you worked as a CEO of London Stock Exchange, like Xavier Rolle, right? So many of them have deep expertise in the industry, either in the financial service industry, or like Shamat in the tech industry, or they might have a hedge fund like Bill Ackman. And based on the expertise and based on the network, they think they can both attract target companies and also attract the pipe investment that's required. And more importantly, there's also some advice required. So my sense is that, and Peter might talk a bit more about it, the companies right now which are looking at the good companies, the target companies, they're not only looking at the valuation and how much they're getting paid for it, but also the backing the sponsor. Anyway, there might be some advice component both through the process and afterwards. And you're also getting a long-term investor, right? Because the sponsor might not be able to sell these things immediately. That means you have somebody who's going to be a stockholder for some time. So just to take a step back, so the sponsors typically are those deep industry expertise and network, but now we are seeing people with the more celebrities coming in and doing that. And because of the regulatory advantages SPACs have, you can give an interview to your YouTube channel, you can go on anywhere and go on tout this SPAC. It's definitely, I think, SEC is right to be concerned. And I think those advice, I think, is well warranted.
Yeah, I mean, one thing that's been extraordinarily interesting in the last, 10 to 12 years in thinking about SPACs is just the amount of information available on the sponsors. When I first heard about these as a practitioner, it had negative connotations, to be clear, that there was a little bit of a backdoor IPO. It was, less transparency around the transaction and the management teams. But most of the SPACs out there now have, fully loaded websites, bios on the management team, and even indications of what type of SPACs they're looking to launch as the new blank checks, and the ones that are still in existence with almost an edict by, we want this to go into a pharma space or some of those other things. So there's a lot more predominance of information around where those SPACs are headed and who the management teams are that are launching them. So you can immediately sort of cross-stitch where that expertise lies. Peter, I don't know if you had anything to add on that before we move off the players.
Yeah, no, like I think Sudheer hit the nail on the head, in terms of my framework of these people being investment bankers, like when, times are good and markets are booming, everybody thinks they can be an investment banker, and who doesn't want to get paid a big investment banking fee? But if you think of all the work that actually goes along with that, there is real work. And so it comes down to, industry expertise, like what is your network and ability to source deal flow, a good deal, ability to bring private capital. So, we talked a little bit about pipes. If you're a guy who is going to bring a deal and put $100 million of your own money in, or BlackRock or Fidelity is going to back you with $100 million of their money, that's an important signal to the market. And, then I think people don't realize, I spent a lot of my time out in San Francisco and Fintech and Silicon Valley. Public markets are way, way different than private markets. And there's a lot of work that goes into it. And so sponsors that have the ability who can really help the management team to get ready for that journey to be in public markets, all the infrastructure they need to put in place. How are they going to build a dialogue and communication with public market investors? Way different than it was when they were private. those are all things that feed into someone who's a good sponsor. And I always tell people, like when I pitch companies to go public via SPAC, I tell them categorically, you hear about these SPAC offs, which I hate. And what that basically means is you get like 10 people putting in bids to go public. Like, I think that's what you do if you're a fintech company and you're going to sell to JP Morgan. You effectively go get 5 people to give a bid because you're going to sell 100% of your company, and whoever pays you, you're just counting the days until you go to the beach. Your life as an entrepreneur is over. It's the end of the journey. But typically a SPAC merger, you're going public and you're selling a small minority stake. And so in the end, to me, you should be focused on maximizing the value of the company in 5 or 10 years. And as we discussed at the very start, 100% of the leverage point you have around a SPAC is your ability to tell your story to public markets. And so to me, it's not about the highest price, who gets the highest price day one. It can actually be against your interest to get the highest price if it means that your stock drops by half the next day because you missed an important opportunity to be in the news every day for a successful deal and get investors on board that are making money, that want to learn more about your mission and your journey. And so much of it to me is that it's partnering with the right partnering with the right sponsor who's going to help you on this journey, structuring the deal correctly so that ultimately you can use the opportunity, of this big event, which is going to get you in the news and on TV, to be able to share your mission with the world and really draw attention to what you're doing, which should help your business on the other end, which will have a real tangible value.
Peter, again, like I mentioned, the sponsor quality is the number one thing in a way, because when venture capitalists look at startups, they always say they're buying the team. It's not about the idea, because ideas might change. They might pivot. The same thing here. I think even from investor point of view, the quality of the sponsor, the network, and how deep their expertise is there. But just to add to that, I think even though this one seems very different from IPO, this initial IPO on where the same traditional investment banks participated. For example, over the last 2 years, Citigroup, Goldman Sachs, Credit Suisse, these are the ones who are doing the initial book building in the SPAC time period. And during the later time period, when the de-SPAC happens and the merger happens, again, you have the same Goldman Sachs, Deutsche Bank, and Morgan Stanley advising the companies in terms of the merger. So those players are there. It's just that I think the sponsor has a very outsized role in terms of raising the money and finding the targets and then doing the pipe and other things. But you have the traditional financial players also in the mix. They do slightly different. That's why the commissions and others might change a bit instead of the 2 or 2.5% for the initial underwriting. And in case there's the acquisition goes through later, there might be another 3.5% that might happen.
Helpful. I'd like to switch gears real quickly here into a fintech discussion around SPACs and how this could impact a lot of the clients and a lot of the companies that are on the call here today. Real quickly, just 2 quick house cleaning items. Please keep the Q&A coming in through the Q&A button at the bottom. We've been trying to answer these as we go, but it's really helpful to kind of direct the conversation. And then 2 points of information. One, if anyone missed it, there was a really well done article on Tuesday around the origination of the SPACs. They actually named the 2 individuals who launched the first SPAC, which was David Nussbaum and David Miller. This was in the Wall Street Journal on Tuesday, if anybody wants to go back because they found this interesting. That article also notes that there's been $75 billion of new capital into the SPAC market this year, which I think is a very relevant data point for some of the questions that are coming in, just to make sure everyone has it. And then the last item, as I noted earlier, the SEC's issued an article that's just an information bulletin today around celebrity-led SPACs, but there's a whole litany of information in the SEC.org website around SPACs and some of the terminology that's used here today, if anyone has any follow-ups. So that being stated, Peter, I wanted to go back to a point you made earlier before we lead into how this affects, fintech companies or companies in emerging markets. One of the things you talked about was, the regulatory differences in being able to talk about your future equity story as opposed to looking backwards on historical information. So I'm going to give just a 30-second blurb on that from a compliance standpoint, and then maybe we can move into what the experience is like for a target who might be looking to partner with a SPAC. So just for everyone's clarification, when you go through a traditional IPO, the SEC actually limits the amount of information you can speak about prospectively on where your company is going financially. You can talk about your equity story in your Form S1, which is the comprehensive IPO document that goes through multiple layers of SEC review, and then bankers are beholden to private versus public information rules and what they can share. In the case of a SPAC, when the SPAC picks their merger partner and they go through the initial registration of that equity, they actually file through a different form and content, which is Form S4 that the SEC puts out. And the rules are less stringent in terms of how you can talk about your future earnings potential, which allows parties, just from a compliance standpoint, Peter and Sudheer would be better to speak about some of the banker and marketing pieces, but it allows you to open up your conversation much more forward-looking. Why that's relevant, I believe, for fintechs, as we all know, a lot of the ideas and ideation of a fintech has to do with where the company can go, more so than the prominence of the historical financials, which might be, in one case, less proven, and in another case, just not relevant enough because of some new technologies or new disruption that company can entail. So I guess just turning over to you, Peter, in terms of, we have companies on the line or on this discussion that are listening in that may want to seek public capital. What is that experience like when they're either going out to seek SPACs or SPACs are seeking them? Maybe you could talk just briefly about, what comes first. In a traditional IPO, you do a bake-off, you pick your underwriter, and then the process sort of runs from there when you get the lawyers involved. How does it work, and what's that SPAC experience look like for fintech companies?
Yeah, I mean, like everything in SPACs, one of the other great thing about the structure is it's incredibly flexible. There's lots of different things you can do with it. And so I'd say there's no standard, meaning there's a lot of fintech companies out there that are getting called, unsolicited from multiple SPACs. Hey, how are you doing? Do you want to go public? There are fintech companies out there that are calling a banker saying, hey, I don't have any revenue, but I want to be public. Can you go get me public? I hear these SPACs don't need revenue. My particular view and where I've spent most of my time is I really think these things are a tool. They're not good or bad. And like I said, they're regulatory advantaged. And so it's solving one of the challenges where if you look at fintech over the course of the last decade, there's been an incredible amount of value, that's built. A lot of these, especially consumer-based fintech companies, are trying to democratize access to asset management products, to banking products, to any of these things. And yet, if you look at the public's ability to invest in them, they can't. I mean, there's accredited investor access, but generally the people who've made all the money are Silicon Valley VCs, strategic investors on down the line. And so for me, the great thing about it is, this is a way that these companies can perhaps get in public markets sooner and give, the public the option to buy. And again, some companies may be overvalued, undervalue. It's not investment advice, but they have a real means to tell the exact same story they're selling to private market investors. And so my view is, like, anybody who really wants to go public via SPAC absolutely should hire an advisor. That advisor hopefully can really help you think through, how can this tool help? What's the process around it? Again, is the SPAC off the way to do it? Is it to find the right sponsor? And if so, what does that look like? How do you do it? So there's a lot of different ways. My view is that that's the best one because, again, it's only a tool. It has a lot of great characteristics, but most fintech companies are focused on whatever their mission is, not on understanding this tool and how it's going to help them going public. And so hiring someone who's an expert at that, I do think makes sense.
I echo Peter's comments. I think one thing I would say is in terms of companies, the timing of it might, again, if you take a couple of examples where I think Paya has gone, I think it's called Paya, our Lending Pro, I think these other companies with Nebula acquisition. So they can take a few months. I think in terms of the entire process, even the initial negotiations that take place between the target company and the SPAC, but even once they announce a deal, afterwards there's again a due diligence, proxy voting. So that might take anywhere from 2 months to 6 months or even a year or more. So it depends. I think there's no one set standard. It depends on the type of company. It depends on the type of SPAC and how easily they can get and any other complications involved in it. The second thing is probably in terms of venture capital. Some of the companies and even fintech companies are thinking of the alternate to venture capital at late stage venture capital maybe. But that's something to think about, slightly cautionary in the sense, are they ready to go public? At the end of the day, once the de-SPAC happens, they are a public company. That means you have to, just like another company, you are bound by the earnings, every quarterly earnings, disclosure of all the information, all the things that come with being a public company. Both the benefits and the costs are there. So is the company ready to be public? I think that's one way. This rising money is definitely there, but is the company at a stage which is ready to be public? That's something I think for these companies to think about, whether it's fintech or other companies. And when it goes to, like, I don't know if some of these companies that are going in, WeWork and SoFi, kind of companies, people know enough about them and they're there for a long time. I don't know how much additional advantage SPAC brings to SoFi, but I think that might be just a quick way of getting into public markets.
Yeah, the speed thing's a really salient point, Sudheer, because when we speak with clients that want to go public because the markets are becoming more advantageous for their asset quality or their investment type, there is a viewpoint in the market that a SPAC is a much more expedited transaction to go public, which I think there is some truth to that, but it also comes with a lot of caveats. One such thing, as you just touched on, is you still have to be in a position to be a public company, and any of the companies on the phone who are public know the ins and outs of having quarterly reporting, investor relations, SEC overhang, regulation, and things of that nature, which can be a very big cost burden on organizations if not ready to be so. And so one of the things that generally slows down or protracts that timeline is just the ability to produce the information and the ability to feel confident that you're not going to struggle as a public company going forward with all that compliance. Two aspects of that. One is there is still a great deal of data that has to be submitted, collated, and organized into financial information, whether you go through a traditional or through a SPAC transaction into the public markets. And the second thing that we found, as a lot of SPACs have launched or IPOs have launched over the past 18 months, is, and a point that you touched on earlier, once you go through the SPAC and the de-SPACing, you are a public company. So the marketability of your shares going forward is dependent on your financial performance and the supply and demand curves for your type of equity in the marketplace. So secondary offerings aren't necessarily like a foregone conclusion at the prices desired. It just kind of ends up in the public markets at that point, because we have seen clients that have gone public either through a SPAC or otherwise, and then had trouble accessing secondary markets at pricing they found advantageous going forward, just because of all the new entrants into the marketplace. So a couple of things that I would add on to that as considerations.
One thing I might say as well is I would echo that. I don't think a SPAC is less work. I don't know that it's faster. It's really the same process in terms of having to provide data, get accounting systems ready, an IR department, like all those things. The second thing is, I'll get called from a lot of companies that they're trying to raise money in private markets at a $30 million valuation and they don't have revenue, but they hear about these SPACs and want to sell to the public markets at a $500 million valuation. Like the most common, again, in any market, a traditional IPO or a SPAC merger, anything can happen. But in almost all these transactions, the real large credible transactions, you have a pipe where Fidelity, BlackRock, like big public market investors are investing. Those investors are even more discriminating than the private market investors. And so ultimately, a lot of this is, are you ready? If you're telling your story to private markets and it's resonating and you're building value, could be through revenue, it could be through technology, patents, it could be through getting scale with customers that someday you can monetize. Whatever's resonating in private markets, a SPAC is a way better way to be able to articulate that value proposition to public markets, in my opinion. But it absolutely is, you're out there articulating that to people who are smart, sophisticated. They're going to have to back this transaction with money. It's not a free money pot in any sense of the word.
Yeah, a couple of the questions that are coming in, I think, are all centering around a similar point. So it'd be good to spend a couple minutes here before we move into general Q&A. But with all of the capital that's flooded into SPACs, throughout the numbers earlier for this year, and obviously there was no shortage of it last year as well, is there any economics that are at play here where there's too much capital and not enough relevant target companies or valuable target companies for those SPACs where we think there'll be an increase of liquidations? Or conversely, if the market is oversaturated, does that drive any pricing down from there? If you guys could comment on where you think that that's going and how that plays out.
I think if we continue the same pace, we might have 1,000 SPACs this year. I don't think it would be partly because of the markets. I think there's definitely a link between if equity markets, for example, if as long as Tesla does well, there's basically more SPACs in the electric vehicles who want to look at these technologies would come in. So a lot depends on, I think, how the markets, the public markets are going to do well, and specifically in terms of how the interest rates might look and what's the link between them. Again, as many of you have noticed over the last 2 weeks, when there's an increase in yields and many growth companies, their stock prices went down, including Tesla and others, because the yields are pretty important. So I would say going forward, that would be an issue in terms of how many firms or how many SPACs can raise the money. That's one. But also the targets they can acquire is also going to depend on, there might not be as many targets for them, the easy picking, some of the targets might not be there. Because as Peter mentioned earlier, they have to be at a certain stage. It's not that suddenly a company which started this year or last year might be ready to actually go public through a SPAC. So the broad idea is how many of those companies are there, which have a high growth, have a story to tell, need the funds, ready to go public. And then how many SPACs are there which are going to bid for the same type of companies. So it's a combination of things. And right now, I think just the statistics, there's 400 plus SPACs which are looking for targets. There's another 200 of the pre-IPO stage SPACs. There might be more coming in the next few months if equity markets continue to do well. There's definitely going to be demand. I think good targets, I think they are going to be very much in demand. But as with any kind of, when there's a good concept, but it's taken to its end and there's some froth, there's some bubble, I think in that, there might be definitely overbidding on some, there might be some mistakes and there might be some liquidations, I think, which might happen, are some targets which maybe the company shouldn't acquire. There's definitely those kind of things might be there, but all depends on how the public markets are going to do in the next, and the interest rates are going to do, and the macroeconomy is going to do in the next 6 months to a year.
And I might add, again, I think there's different things going on from different perspectives that are all important. One is post this Virgin Galactic transaction, you absolutely saw a better quality company in more of these innovative industries going public. I think until recently, they'd stayed private longer. And so there's a decade worth of private companies. So there are a lot of good quality companies that I think will be going public via SPACs in the upcoming years. That then touched off this issuance boom that I would say, again, in the context of these sponsors being investment bankers, it's almost like a land grab. These guys are now launching vehicles to try to establish an investment banking franchise. And whenever you have this disruption in land grab, some of them will, some of them won't. I agree with Sudheer, it's not going to go on indefinitely. You're not going to be able to issue supply. And again, I think of in the context of this is a supply of future IPOs out there. You can't issue unlimited supply that doesn't get grounded in demand, right? And so I think what that means is the best sponsors are going to compete for the best deals. One thing to think about from an investment point of view, if you're investing in SPACs, is unlike an investment banker that has no skin in the game, that if he doesn't find a good company, he just won't do an IPO. These sponsors do have an incentive. If I'm a sponsor out there and 2 years is almost up and I haven't been able to attract a good company, I have an incentive to bring some company public as opposed to, do no deal. And so if you look historically, there's been a big bifurcation of returns where the best companies, are these growth companies, they can go on to change the world. But if a bad company comes public too early, the outcomes don't tend to be pretty, and they don't tend to go down a little, they tend to go down almost to zero. And so I do think you're going to see a couple of years of turbulence where, people are trying to get their heads around what this new world, this landscape of IPOs, via SPACs looks like. It's going to lead to all kinds of friction that, you got to just be careful in terms of how you navigate it. But yeah, in the end, you are going to see more and more of these companies go public via this route. The cost is going to come down. All this issuance of future IPOs means that people are going to compete for the best deals, and it's because they don't get paid in cash. They get paid in equity that, ultimately, to the extent they do a good deal, is going to be worth more. And if their deal goes to zero, is going to be worth zero.
Yeah, and a couple just mechanic points on that, Peter, that I think is important just to wrap up in terms of the SPAC transactions themselves. The SPAC will have the denotation of a SPAC for the period until it does its acquisition. When does it cease to be a SPAC? I mean, generally speaking, these are affected through a merger, what we would call like a reverse capitalization, where the entity that's purchased is the surviving entity in that merger. So in the Virgin example, when you look up Virgin and it's trading, it's Virgin. It's not, trading as a SPAC. And then second part of this question is, after answering when does it cease to be a SPAC, is there any incentive for ETFs or other funds to hold those investments post the SPAC transaction? I think that also just comes down to how well and how that fits in based on the target company and its relevance to the investment thesis of that fund. But if you could touch on those couple things before we move into one last question, that would be helpful.
Yeah, no, absolutely. So, I look at the various stages of the SPAC's journey. One, the sponsor puts up money, takes it public. Then you invest in the IPO and, you have this weird hybrid instrument until they announce a deal. Then between the time they announce the deal and when it closes, you actually know what company they intend to merge with. And then when it closes, the reality is it shouldn't be distinguished as a SPAC, or it doesn't matter if it's distinguished as a SPAC. It's like any other company. It can go to zero, it can go to something. And so I would say, what I like about these things is all those stages of the journey are super interesting. More than any other vehicles I've been involved with, they provide, different ways that you can interact with them. They all have different characteristics. We actually did launch an ETF that holds the SPACs or the companies that come out of SPACs. And again, the importance there is not that they are SPACs or were SPACs. The idea with that kind of ETF is simply that, if you would have invested in pre-IPO rounds of a cross-section of innovative companies every year for the last 10 years, that would have been a great way to allocate a part of your portfolio. The problem is that normal investors couldn't do that. That was what Silicon Valley investors did, some accredited investors. But because SPACs are allowing these companies to go public earlier, the idea is simply that, these companies that emerge from these innovative industries that come out earlier, some are not going to do well, some are going to do great and change the world. It really is meant to be an actively managed portfolio of growth stocks, because again, like any venture capitalist, you're not going to back one company and say, this is going to win or lose. You back 30 companies. You have a process around doing that. You size them a particular way. I think that's the idea around some of these ETFs, is to give, investors an easy, way to access what absolutely is something that is, a changed world in terms of these companies' ability to be able to access public markets in a good way.
I echo with Peter. I think in terms of it's important to diversify, because these are by definition innovative firms and high growth industries. So by definition, there's going to be some huge success, but there's also going to be many failures. Like in the history of, again, hundreds of years, financial markets, there's always, I think there will be some stellar success, but there will be some failures. That's why from an investor point of view, I think it's important to have diversification rather than just one. I think, and this, as to the extent that these ETFs provide that, I think that's a great thing, because now I think it's a one company that invests in a bucket of them.
I agree. And, with all the products we've designed in SPACs, I think it's diversification, number one. But I actually think this is one area where you absolutely want active management. And it just comes down to, like, if you own every SPAC, some of them are going to go up a lot, some of them are going to go to zero. I think, simple active management can add a ton of value, by effectively just highlighting winners and cutting losers relatively quickly. And, when you get into the pre-combination SPACs, again, all these characteristics, you're effectively managing a portfolio of options, and it's just a time intensive, it's a theoretical intensive exercise that, like, for me to, in my, E-Trade account, own 50 SPACs, it's a full-time job to manage that whole process. And so I do think it's super interesting. There's all these neat things going on. I do think it's one of the areas of the market where active management is just really critical.
We have time for one last question, just being mindful of everybody's schedules. And I think I saved this to the end because I think it's really, relevant and important. And so if you guys could give me a quick 30-second to 1 minute blurb on this, but given all of the importance of ESG investing and what a lot of the large fund and equity houses have made proclamations of, so like BlackRock, for instance, has a very specific edict about how much of their investments they want to make into ESG relevant companies. What role can SPACs play in either augmenting efforts or imploring efforts around diversity, minority-owned businesses, and other aspects of ESG, given as we've talked about all the relevance of information and forward-looking, data points that can be used for the capital raise?
Maybe I can start on that one. I don't think, again, I've been doing research on ESG and impact investing for around 15 to 20 years. One thing I would say is there's a lot more talk about ESG than I think walking the talk in terms of both from institutions and also in terms of the companies. I have some work on that. Even institutions, I think because right now retail investors, many investors, I think ESG matters a lot. So I think there's a lot of, talk, from all the pension funds to BlackRock to everyone, on ESG. But how much of it translates to actual active ESG supporting initiatives at companies and how much the companies do differs. So per se, I think that's for any public company or any private company. So for a SPAC, I don't know there's anything separate for a SPAC because some of these are in innovative industries which might be like more environmentally friendly, for example, electric vehicles, right? I think so that from that angle, they might be positive for a SPACs, maybe positive for ESG. But apart from that, I don't know whether the SPAC process itself does something for ESG.
What I would say is, I believe public markets are better suited for mission-based companies. If you think of a company like Tesla or Beyond Meat or someone, people don't just invest in that for the current economics, but it really is a community aligning around a mission of how a company is going to transform something. And obviously those are big, huge examples. And what I've found, I actually personally advise a company called Aspiration that's building a socially conscious banking platform, one of my favorite companies in the world. The point I've always made to them is, if they're out raising money in private markets, all the Silicon Valley, VCs, they don't really care so much about the mission. They're all investing in customer acquisition and, revenue, whatever it is in order, for them to follow their process. BlackRock, Fidelity, like these guys absolutely, are trying to invest aligned with their values. And there's a supply demand imbalance. There's not enough companies that really, at its core follows those values. They talk about greenwashing and trying to make a normal company seem like that. But I do think for ESG companies, for companies that are really trying to transform the future, that are really mission-based. Again, the thing about a SPAC is it's not every company that is big enough and a brand name enough that can just do an IPO and everybody knows who they are. A SPAC really gives them a much better platform to be able to tell not just the Fidelities and BlackRocks of the world, but more broadly, public investors, their vendors, like everybody, why they formed the company, how are they going to change the world, all those principles. And so I actually do think ESG is going to be a bigger and bigger part of, the companies that are going public via SPACs. You've already seen it if you look at it broadly, electric power, electric vehicles, like those things are squarely in that category. But I do think, with climate change and all the pressures on our planet and, social issues and things that we're dealing with, I think more companies are going to be formed to address those in the coming decades. And, those companies, I think, unless there's some regulatory change, are going to gravitate to SPACs as the means to get the public capital they need.
Thank you. Well, I think we're up against the hour. So I just want to make sure I said thank you to yourself, Peter and Sudheer, for taking the time to walk us through this today and share a vast amount of knowledge and experience in this space. And also a very special thanks to Rebecca Markuson, Amber Cutler, and Jeff Capasan, who helped organize and get the group together and do all the logistics. So thank you to everybody. And if there's any Q&A that didn't get answered and you want to email anybody directly, I'm sure Rebecca can get you guys our contact information. We can answer anything offline as well.